Live from Music City, this is your motivational, sensational, inspirational, educational, keenly awaited, highly anticipated edition of What is a Mortgage, brought to you by Real Life Trading. We're here at Kids Month. Boys and girls, people from around the world, how is everyone doing on this fantastic day, night, week, year, month, whenever you're watching this? Helen's here. What's going on, Helen? How are you? Lisa, pleasure to be with you today in this beautiful afternoon environment. Ryan, what's going on, Ryan? So as you all know, today we're discussing what is a mortgage for Kids Month. Every single March at Real Life Trading, we have Kids Month, where we discuss for kids and with kids what the stock market is, what investing is, different things about different aspects of finance. And today we're going to be talking about a mortgage. So we're not going to be here more than 15 minutes. Of course, if there's any questions, feel free to type them into the chat pane just to make sure we know where we're at. Throw in a 1 if you can hear me and you can see me okay. Let's see. All right, fantastic. Getting some 1s. That is good. Let me pull this up. 1. Lisa says, hi. What's going on, Lisa? How are you? Carolyn, thanks for being here, Carolyn. Hope you're doing wonderful. And for all the kids out there in the world, welcome. Thanks so much for being here, boys and girls. You guys absolutely rock. And for the adults who might be watching this as well, just wondering what my thought is on a mortgage. I appreciate being here. So let's talk about this again. We're going to be pretty quick today, 15 minutes, because we can talk about what a mortgage is very quickly. The word mortgage actually comes from a French word, meaning the French word is mort, M-O-R-T. Mort, M-O-R-T. So you can kind of think of like a mortuary almost. Mort, meaning death. So technically, it means engaged until death. That's so a little bit of a depressing background to the word mortgage. Yes, I fully agree. Now, what's interesting to take away from that is a mortgage is one of the biggest things that we as humans on this earth will ever actually do anything with, purchase, buy, or be affiliated with in some way. Mortgages are one of the biggest decisions that us as adults will make in our lifetime. So it's always very important to do a lot of homework and make sure you're doing the right ones. So there's a lot of stuff for us to talk about, but let me explain what a mortgage is for the kids who are here. So we got some arrows, we got some figurines, we got some drawings. Let's talk about this. So first and foremost, a mortgage comes with the starting and the looking to get into a home. So if you want to buy a house, why would you ever want to buy a house? For those who are here live, especially the kids out there, why would you want to buy a house? What would be the benefit? So you could live in it. Exactly. So you could live in a home. So you want it to want to live. So if you're going to be buying a house, you want to own a house rather than rent an apartment, you need to purchase it. So in buying a house, oftentimes it requires a lot of money. Dollar bills, y'all. It requires a lot of money in order to buy a house. Oftentimes it requires more money than you have. So what has to happen is real life people have to go to something called a bank. And a bank will provide that person or a couple or the family the house that they want. Now, they're not just going to give them the house. The way it works is they provide something called a loan. And we'll discuss loan in just a little bit. But the type of loan that they're going to give these people is identified as a mortgage. Mortgage, because there are other types of loans out there. There's numerous types, right? So you can have a student loan, you can have a loan for your car, you can have a home improvement loan. There's a lot of different, there's thousands and thousands of loans out there. But a very specific type of loan from a bank is called a mortgage. And that helps you purchase a house or a home. So the bank actually has an interest in the house. So they want this house and they want to make sure that you pay for this house. So when you are buying a home, they set up this mortgage, this loan for you, and they charge you interest on that loan. So when they're giving you money, a bank would give someone money so that they give that money back. Right, which is a nice thing to do. But when a bank gives people money, they expect more money than they give. So let's kind of draw an arrow. So let's say, for example, the bank gives 1 red arrow worth of money to somebody. They're going to be expecting in return 2 purple arrows back to the bank. So if the bank gives someone a certain amount of money for a home, they're not doing it out of the kindness of their hearts. They're doing it so that they can receive something in return. An interesting fact, the national average here in the United States of America for a home loan is approximately $222,261. So that's the average home loan, with approximately $1,061 as your average monthly payment for a 30-year mortgage at 4% interest according to LendingTree. So kids, think about this really quickly. If you're looking at buying a house, $1,061 is approximately how much you have to pay. Now, here's a question that I ask. Do you have to pay that daily, weekly, monthly, or yearly? That $1,061, is that a day, week, month, or yearly type of payment? That is an amount that is paid. You guys are absolutely correct. Wonderful job. That is paid on a monthly basis. So you're making that payment every single month to the bank. Monthly basis. Now, if you want to pay it off quicker, which we'll talk about in just a little bit, you can pay weekly if you prefer. But the more you pay, the faster you can pay that house off. But the requirement is at least initially every single month. So we talked about some terms here, and let's kind of define a little bit more. So there's 4 other types of terms that you're going to hear a lot when it involves a bank. You're going to hear the term loan, interest, down payment, and escrow. So let's talk about those 4 types of terms really quick. A loan is simply, by definition, when a company or a person loans you money for something, whatever that might be. So a loan is always something that you should take very seriously and make sure that you pay back. So if you receive money from a person or a company, you want to take that very, very seriously, and you want to make sure that you pay that loan back. A next term is called interest. Interest is the reason that a company or a person will loan you money. Interest is what we pay when we are borrowing money. So if we borrow money from a person or a company, they're often going to charge a specific interest on that loan. So for example, if they loan you $10,000 at 10% interest for a year. So you have $10,000 at 10% interest for 1 year. The loan, the actual amount of money that you receive is $10,000. But the amount of money that the person or the company receives who loaned you the money is actually $11,000. So they get an additional $1,000 back from you because they allowed you the convenience of having their money. So you get $10,000, you do something with that $10,000, and then you have to pay back $10,000 plus an additional $1,000, totaling $11,000. So this is what that interest is, that interest rate. So obviously the higher the number of interest, the bigger the number, the more you have to pay back, and the lower the number, the less you have to pay back. Here's a quick question. Would you prefer a lower interest rate or a higher interest rate when borrowing money? You would prefer a lower interest rate. Exactly. So the lower the better if you're borrowing money, because that means that is a less amount of money that you have to pay out of your pocket and to pay it back, that loan. Another great term is something called a down payment. A down payment is a certain amount of money required to get a loan. So it's not like you can just walk up to somebody like a bank or a company and go, hey, I would like a loan, please. So a down payment is actually an amount of cash that you have to have before you can even get a loan. And it's a percentage of the total amount. So for example, if you borrowed $1,000, the question, if you borrowed $1,000, what would a 10% down payment be? So if those are here live, you're welcome to write that down. If you're watching this on the internet, you can put it in the comments section below, or you can email me the answer, jeremy@reallifetrading.com. But if you borrowed $1,000 from a company or a person, what would a 10% down payment be? So 10% down payment, what's 10% of $1,000? $100. Yep, exactly. So that would be the amount of money that you would have to pay initially as a down payment. And then here's a popular term that actually a lot of adults don't even fully understand, and I'm making this definition as simplistic as humanly possible, but an escrow. There's a term escrow. That's a type of account where your money is held in order to make automatic payments toward your loan. Okay, so that's what an escrow is. So when you're putting your money into an account for your loan, the escrow is the holding party that makes sure that your loan gets paid. And if your loan doesn't get paid, people are going to be very, very upset with you, and it's not a good position to be in. So if this escrow doesn't have money in there at all times, it's going to be a bad day. They're going to come after you, and they're going to make sure that they get their money. So an escrow is kind of an account like a holding party, a third party holding location. So there are 3 types of mortgages, right? So you have a mortgage. So a mortgage, as a review, is something that a bank gives you. It's a loan so that you can buy a house. There are 3 types. There are 3 main types. There's actually many other ones. We're not going to get into those today, so don't worry. The 3 main types that you will be interacting with in your lifetime, more than likely, is a fixed rate mortgage, an adjustable rate mortgage, and a Federal Housing Administration mortgage, also known as an FHA. So these are the 3 types of mortgages. The fixed rate mortgage is the most popular. This is what most people in life get. This is the most common type of mortgage. You pay a certain percentage money over a long period of time. So kids, a mortgage is something that lasts for a very, very long time. For example, most mortgages are a 30-year mortgage. So you're borrowing a large sum of money and you're paying it over a very, very, very long period of time. Now, some of you might be thinking, can you pay off a mortgage early? The answer to that question is absolutely yes. In fact, I always encourage you to pay it off early because this is what it looks like if you do not pay off a mortgage early. So this is a proportionate amount of interest on a $200,000 mortgage. Amortized is just a special word for spread over. Amortized for 30 years at 5.5%. So what that looks like is the line here in light purple, this is the amount of money that you're going to pay. So again, if you borrow $200,000 from a bank, you have to pay that money back. So if you have an interest rate of only 5%, which is actually pretty low, if you pay that for over 30 years, you actually pay more on interest than your original mortgage was for. So you pay $208,482 in just interest. So your true cost of your mortgage usually is about double what you actually borrow if you pay everything on time. Now the funny thing is that is if you do everything the way you're supposed to do, meaning you pay on time, the amount of money that you're supposed to pay on time. So it's often encouraged if you get a mortgage to make sure that you can comfortably and easily afford to pay more than the mortgage continuously. It's often noted to take your mortgage number, so let's say your mortgage number is $1,000, and divide that number by 2, so you'll have $500, and then add some money to that, so whatever you're comfortable with. So let's just say you want to add $50 to that number. So instead of $500, it's $550. So you pay $550 on your mortgage every 2 weeks. Every 2 weeks. So you give your bank that mortgage payment every 2 weeks, and that will drastically reduce the amount of interest that you pay and how long you end up paying. In fact, doing that exact strategy can cut down the cost of a mortgage by over 35% and can cut down the amount of time that you pay a mortgage on from 30 years to 22 years. So it's a huge, huge reduction in savings. So for my adults watching this, again, that's a very, very important strategy to make sure that you can pay off that mortgage as quickly as possible, because for most people, the mortgage is their biggest expense that they have. And if that can be totally wiped out quickly, it's a huge pressure relief. Now, let's talk about the other type of mortgage. This is an adjustable rate mortgage, also called an ARM. So if you ever hear the term ARM, it's an adjustable rate mortgage. When you have an adjustable rate mortgage, you have lower payments to start off with, but over time they can fluctuate drastically. So you might start off with, let's say, a $400 a month payment, and you're like, oh man, I can easily afford this. This is so simple. I'm paying off my house only $400 a month. Well, 4 years from then, it could go up to $1,800. It depends on a lot of different factors, but the interest rate is one of them. Not to mention if your home is going up or going down in value, what your credit score is doing. There's a lot of factors that can go into an adjustable rate mortgage. Most people say that adjustable rates should be avoided if at all possible. I've never had an adjustable rate mortgage, and here's kind of like a little bit of a graphic for you. The pros and cons, if you will. So the fixed mortgage, the average mortgage, gives you something that's more predictable, right? And when you take an adjustable rate mortgage, you assume the risk that your interest rates are going to go up and you actually pay more than you initially thought that you had to. So last part of the class for today, what is a mortgage? FHA stands for Federal Housing Administration. And this is my personal opinion, but I personally think FHAs is a great way for first-time home buyers to purchase a house, because oftentimes you need little or no down payment in order to get an FHA loan. Now, there are a lot of adults going to watch this and say, well, Jeremy, if you get a Federal Housing Administration loan, then you're going to have to pay private mortgage insurance or something called PMI, because if you don't pay, if you don't have a down payment, then you have what's called private mortgage insurance, PMI, that you have to pay. And honestly, this number is so small. It usually it comes up being the exact same or a little bit more than you would have saved up for a down payment. But if you're a younger person, let's say you're 18, 19, 20, you can get a home right now for almost no down payment. And so if you know for sure that you make it your absolute utmost importance to pay that mortgage every single 2 weeks, right? Not every single month. Put it in your mind that you're going to pay it every single 2 weeks. You can get a home, and instead of going to college and renting and paying enormous large sums of rent that you're never going to get that money back, you can buy a home at a young age, live in it, pay less, far less than you pay in rent. And then once you leave for college, you can go and rent that house out, and now you are becoming an owner rather than just a buyer. So personally, I really like the FHA approach. That's the first way that I bought my first home. And for younger people or traders or people from around the world that might not have that much cash on hand, FHA is a great loan. So for those who are watching this recorded, thank you so much. For those who are live, you guys absolutely rock. I know that was a quick session, but really, that's what a mortgage is. If you have any specific questions about that, feel free to post that in the comment section below on our YouTube channel. If you have a Twitter, you can follow me at Newsome Nuggets, and you can ask me any question that you want. If there's a video that I do not have, you can always message me the question that you have, and I'll be happy to explain it any way I can. But for those who are here, thanks so much for being here. I hope you learned a lot. If you have any additional questions, let me know. The next kids webinar in the near future is called How Do Credit Cards Work? So we're tackling right now the two biggest things that most adults don't even fully comprehend, and we are going to crush this. Folks, you're amazing. Thanks so much for being here, and until next time, love life, live life, and trade it. I'll see you later. Bye.